Welcome to Business with Louis, the podcast where we dive into the world of entrepreneurship and explore the concepts that drive business success. Today, we're going to talk about a fundamental principle that underlies every business decision: risk versus return. Risk versus return is a concept that's easy to understand, but often difficult to apply in practice. Essentially, it refers to the trade-off between the potential rewards of an investment or business venture and the potential risks involved. Every business decision involves some level of risk, whether it's investing in a new product, hiring new employees, or expanding into a new market. But how do you know when the potential return is worth the risk? The concept has been around for centuries, but it wasn't until the 20th century that economists like Harry Markowitz and William Sharpe developed the modern framework for understanding risk and return. They introduced the idea of the efficient frontier, which suggests that investors can optimize their portfolios by balancing risk and return. One of the key principles of risk versus return is the idea of risk tolerance. This refers to an individual's or company's ability to withstand potential losses in pursuit of higher returns. For example, a young entrepreneur with a high risk tolerance might be willing to invest all of their savings in a startup, while a more conservative investor might prefer to diversify their portfolio and aim for lower but more stable returns. Jeff Bezos, the founder, took a huge risk by investing all of his savings in the company and expanding rapidly into new markets. The potential return was enormous, but so was the risk of failure. The potential return on investment was significant, but so were the risks, which ultimately led to the company's downfall due to fraudulent practices and technological failures. These examples show us that understanding risk versus return is not just about chasing high returns. It's also about being aware of the potential pitfalls. Another key concept related to risk versus return is diversification. This refers to the practice of spreading investments across different asset classes, such as stocks, bonds, and real estate, in order to manage risk while still pursuing potential returns. For example, a company like Google might diversify its portfolio by investing in a range of startups and established businesses, rather than putting all of its eggs in one basket. So, how can you apply the concept of risk versus return in your own business ventures or investment decisions? First, it's essential to assess your risk tolerance. Are you comfortable with the possibility of losing some or all of your investment in pursuit of higher returns? Or do you prefer more stable, lower return investments? Understanding your personal risk profile is key to making decisions that align with your goals and financial situation. Second, diversify your investments. Spreading your investments across different asset classes can help manage risk while still pursuing potential returns. This strategy is based on the idea that different investments will perform well at different times. So by diversifying, you reduce the risk of losing money if one investment performs poorly. Third, stay informed but avoid emotional decision-making. Market volatility and economic news can be unsettling, but it's crucial to separate noise from signal. Make decisions based on thorough analysis and long-term strategies rather than short-term market fluctuations. Finally, consider using tools and frameworks that can help you evaluate risk versus return. For example, the Sharpe ratio is a metric that helps investors understand the relationship between risk and return by calculating the excess return of an investment over the risk-free rate relative to its volatility. Other tools, such as decision trees or scenario planning, can also be useful in evaluating potential risks and returns. In addition to these strategies, it's also important to consider the role of uncertainty and ambiguity in business decision-making. As the economist Frank Knight once said, "Risk is measurable, but uncertainty is not." This means that even with the best analysis and planning, there will always be unknowns that can affect the outcome of a business venture. To mitigate this uncertainty, entrepreneurs and investors can use techniques such as scenario planning, which involves imagining different possible futures and developing strategies to respond to each one. They can also use tools like Monte Carlo simulations, which can help estimate the potential outcomes of different investment scenarios. In conclusion, risk versus return is a fundamental concept that underpins every business decision. It's about understanding the trade-offs between potential gains and possible losses, and making informed choices that align with your goals and risk tolerance. Whether you're an aspiring entrepreneur or a seasoned investor, grasping this concept can help you navigate the complexities of the business world with confidence. By understanding your risk tolerance, diversifying your investments, staying informed, and using tools and frameworks to evaluate potential risks and returns, you can make more informed decisions and achieve greater success in the world of business. Thanks for tuning in to this episode of Business with Louis. Like, share, and subscribe. And remember, every great business starts with action. Make your next move count.